Hi, this is Dave Bolduc with the Bella Group. Welcome to my weekly real estate market update. It's February 25th, and I wanted to cover a couple of topics today. One that I said that we're pretty much done with, but there's been a lot of noise in the news that is misleading, so I wanted to touch on it, and that's foreclosures. The other one is mortgage, which I hit on every week. So let's jump into the foreclosures now. This slide is showing the continued burn down in the forbearance. For mortgages that are in forbearance, we're down to about 780,000 in January. So we're on a good trajectory there. And this chart shows that we're continuing to see over 4 out of 5 mortgages successfully exit the process. Little less than 1 out of 5 are still have some issues as they come out of the process. So if we take that 780,000 mortgages that are in forbearance still and we apply these numbers, we expect to see about 150,000 come out that are at some kind of risk. Let's assume that those all go into foreclosure. That's less than 1 month of inventory. So if all of those went into foreclosure and we resulted in 150,000 houses that going into foreclosure and hitting the market at the same time, which they won't, they'll come out over a period of time, we'd get a little less than a month of inventory. It's not enough to make a change in the market, and certainly not crash the market considering our current position of somewhere between 1 and 2 months of inventory across the country. So foreclosures from forbearance driving the market down, it's still not something that's going to happen. Now, looking at the media, there's a couple of headlines that I pulled off a quick internet search. Foreclosures are at highs since the highest they've ever been since the pandemic. Of course they are. Starting on March 18th of 2020, foreclosures were in a moratorium. You couldn't do it anymore. And that ended July 31st, and it takes some time to get the ball rolling. So, of course, we're going to see foreclosures start to come back up, and I think they'll get higher than where they are today. But the information that's being provided is a little bit misleading. So the one thing I will say is look at the actual numbers, not the percentage change, and do your own research. So here's the real numbers. The real numbers, if you look at them, the first thing that jumps out at me is that January 2021 isn't there. Why is that? Because there was a moratorium. There were no foreclosures completed during that time. So it's a zero. So if you compare January 2022 to January 2021, of course you're going to get a massive increase because you're going zero against 4,700. Now let's go back to 2020, right before COVID hit, and you can see that we're at half. And if you go back to 2019, we're at about 40%. Right now, we are significantly lower in number of foreclosures than we were pre the COVID-19. And we expect to see that continue. And this quote really hits the point home. It's very important to keep these numbers in context. We're likely to continue seeing large year-over-year percentage increases for the rest of the year. But it's also likely that foreclosure activity will remain below historically normal levels until the end of 2022. And this is from Realty Track. So the takeaways: the media is cherry picking data to fit a narrative to get clicks, right? And do your own research. Foreclosures will increase, but comparing them to year ago numbers, it's not a valid comparison because there were none going on. Actual numbers of forecasts are less than, of foreclosures are less than 50% of pre-COVID numbers and are expected to increase but stay at or below those pre-COVID numbers. So moving on to the mortgage side of the house, little bit of good news, slight decrease from 3.92 to 3.89 in the primary mortgage market survey, which was completed yesterday. They do it every Thursday. This is an interesting blog that I found that describes why mortgage rates track the 10-year Treasury yield. So the TLDR on it is the Treasuries and mortgage-backed securities, which are a bunch of mortgages grouped together and sold as security, are competitors for each other for investors' money. So in order for mortgage-backed securities to stay competitive in investors' eyes, mortgage rates follow Treasury yields. So I'm sure there's more to it than that, but that's part of the explanation that's in there. It's a good read to kind of give you an idea. What does this mean for buyers? There are many factors influencing mortgage rates. The overall consensus is that rates are going up. We're still near historic lows, and I'm going to show you a chart. If you're ready to buy, locking in current interest rates may be your best bet. And of course, if mortgage rates drop, you can just refinance at that point. So I'll close with this chart. Current mortgage rate, 3.89%. We're still below the last decade's average, and you can see well below the decades before that. So even though we're not at that extreme low that we were at just a couple months ago, we're still in very favorable territory from a mortgage rate perspective. So hopefully you got some great information out of this. If you did, please click the like button, subscribe, and ring the bell so you can get notifications when I put out my weekly content. If you have any comments or any data that you think is different, let me know. I'm always learning. Maybe I missed something here. My winter buyer and seller's guides are available. The links are in the description. You can grab those for free. There's no obligation. Until then, look forward to talking to you next week. Have a great day and stay warm today.